Hello everyone, good morning and welcome to the mock paper solving of AAA in the revision revolution. So today we're going to start a mock and let's see how much we can complete. Then whatever is left we're going to do it tomorrow. And then tomorrow we're going to start one more mock and do how much ever we can finish. So we're going to do one full mock and one part of the mock. Okay. So let me share the screen with you. We will start doing the mock. So this is the mock that we're going to do today. So as I told you, the paper pattern is section A is 50 marks, section B is 50 marks. Section A is one question of 50 marks, section B is two questions of 25 marks each. So we have done like 4 questions of section B. So a lot of section B is already solved in our revision revolution lecture. Now we're going to proceed with section 1. Let's see how to solve a very big question like this one. One full section B question, section A question we'll do, that is a 50 marker. You all will get an idea of how to solve a big sum, a big problem and not get scared by it because it's an entire 50 marker. I am just telling you, I told my students in AA also, the more the data the better it is, because the more the question is bigger and the more the data that they're giving you, you can use that data to write your answer, right? So it's a positive thing, you take it positively. So let's read the question. The instructions for the question will remain the same. You have to read the requirement first and then the question. If you see the question, they've split section A in 35 and 25. So we'll solve it that way, okay? And this is the requirement. So requirement A says evaluate the business risk facing the group for 10 marks, whatever the business risk that this particular group is facing. Identify and explain the significant risk of material misstatement which should be evaluated as a part of our audit planning. In respect of the email received from the finance director, discuss the additional implications for planning the group audit and explain any relevant actions to be taken by the firm, and recommend the planned audit procedures to be performed on the claim of $10 million, assuming that the audit team is given access to all relevant sources of audit evidence. And for this you have all this information. And then this is the extract for John. And required, then 4 marks you have respond to the instructions in the partner's mail, and these are the instructions in the partner's mail that you have to respond, all these instructions. Okay, A, B, C and C part 2. And then this is another part, and you have to comment on the matters to be considered and explain the audit evidence you should expect to find during your file review in respect of each of the issues described above. You are not required to explain the potential impact of the matters on the auditor's opinion report. And the marks is, the split of mark allocation is shown against each of the issues above. So what are the issues? The first issue is the decommissioning provision, for that we have 10 marks. Next is depreciation, for that we have 8 marks. Then is trade receivables, for that we have 7 marks. So for each of the issues. And then section B, 2 questions of 25 marks each. Okay. So just give me a minute, I'll just open the So now, since September 2022, you have 20 marks allotted for professional, and a lot has been changing over time. Now, this question paper that we have picked up is a little bit older one, that is, it's a 2017 paper, and this is a sample paper. Okay, that is why they have split the section A in two parts. But normally in the exam, section A is going to be a complete 50 marker question. So, just consider it as a continuation of that. Okay, so no problem about that. It will just give you an idea of how to solve the 50 marker in a given time frame. So the first thing we have to do is evaluate the business risk facing the group. Or wait, I'd rather pick a recent exam paper. Just give me 1 minute. So if you look at this paper, this is a past paper, okay, which came in the examination on Monday, 3rd September 2018. So it was after the paper that we just took, this one, after that. So for this, if you observe, there is one question compulsory and must be attempted, and this is for an entire 50 marks. And then you have the exhibits to answer that, right? Entire 50 marks, and the split of the marks is here. So 24, 6, 10, 6, and then the exhibits to answer that. And then you have section B. See, one is so big, and then you have 4 to 5 exhibits to answer that. And then you have section B for 2 questions. So section A is 1 question of 50 marks each, and section B is 2 questions of 25 marks each. Now the professional marks of 20 got incorporated from September 2022, and this is a September 2018 paper. So from now on, the professional marks for section A will be 10 and for section B will be 10. So this question of section A, which is 1 question of 50 marks, will actually be of 40 marks. So you can concentrate well on that 40 marks, and 10 marks will be for your presentation, communication skills, headings, subheadings, and all of that. Okay, so that is a recent development which came last year. So let's solve this Monday. So this is an exact past exam question paper. So let's solve this one. And I want you all to read through it. So you have to first read the requirement, and then we start the question. Okay. So I'll just open this part. So let's do a recent paper only, so that will kind of give you an idea of how to do the paper. So let's read the requirement. Required, respond to the instructions in the email from the audit partner, which is for 46 marks, and the split of marks allocation is shown in the partner's email, that is in exhibit 1. So let's look at that. Using the information provided, I require you to prepare briefing notes for my use in which you evaluate the audit risk to be considered in planning the group audit. You should use analytical procedures to assist in identifying audit risk. You are not required to consider audit risk relating to disclosures, as this will be planned for later in the audit process. That is for 24 marks. Okay, so you identify and you have to evaluate the audit risk, and you should use analytical procedures to assist in identifying the audit risk. Then for 6 marks, design the principal audit procedures to be used in the audit of goodwill arising on the acquisition of Links Company. Management's calculation of the goodwill is shown in Exhibit 4. You do not need to consider the procedures relating to impairment testing or to foreign currency retranslation, as this will be planned later in the audit. Using the information provided in Exhibit 5, evaluate the extract of the audit strategy prepared by Vulture Associates in respect of their audit of Links Company and discuss any implications for the group audit. And after considering the request in Exhibit 2 from the Group Finance Director in respect of our firm, provide advice on the group's integrated report, discuss the ethical and professional implications of this request, recommending any further actions which should be taken by our firm. Thank you. And then these are exhibits. So first let's read the question. You are a manager in the audit department of Bisson and Company, a firm of chartered certified accountants responsible for the audit of Eagle Group, which has a financial year ending of 31 December 2008. Your firm is appointed to audit the parent company Eagle Company and all of its subsidiaries with the exception of Links Company, a newly acquired subsidiary located in a foreign country which is audited by a local firm of auditors, Vulture Associates. All companies in the group report using the IFRS standards as applicable financial reporting framework and have the same financial year end. You are provided with the following exhibits. So what are the exhibits? There are total 5 exhibits. First exhibit is an email which you have received from Maya Karg, the audit engagement partner. Second exhibit is the background information about the group, including a request from the group finance director in respect of a non-audit engagement. Third extract is from the group financial statements projected to 31 December 2008 and comparatives, extracted from the management accounts and accompanying explanatory notes. Fourth exhibit is regarding management's determination of goodwill arising on the acquisition of Links Company. Fifth one is an extract from the audit strategy document prepared by Vulture Associates relating to Links Company. And then you are required to respond to the instructions in the email from the audit engagement partner. So the first one is email from the audit engagement partner, Maya Karg. What is the subject of that? Audit planning for the Eagle Group. I have provided you with some information in the form of a number of exhibits which you should use in planning the audit of Eagle Group, the group. I held a meeting yesterday with the Group Finance Director and representatives from the Group Audit Committee, and we discussed a number of issues which will impact on the audit planning. Using the information provided, I require you to prepare briefing notes for my use in which you will evaluate the risk. This is what we read, this, and thank you. So this is what is required by audit engagement partner Maya Karg. Okay. For that, I have to first identify the audit risks. So I will solve the first part first. I will solve this answer in parts because it is very difficult for me to remember the entire question considering that it is a 50 marker. So I will pick one requirement, do it, second requirement, do it. Now considering it is a 50 mark question, I get 1.8 minutes to do it. So I get 90 minutes to do it. 90 minutes means I get 1.5 hours to do it. So I can do it properly. So I will first take the A part. Evaluate the audit risk to be considered. In planning the group audit, you should use analytical procedures to assist in identifying audit risk, and you are not required to consider audit risk relating to disclosures, as this will be planned for later in the audit process. Okay. I have to pick audit risk from this background information about the group, right? So let's read Exhibit 2. Background information about the group and request from the group finance director. Group operational activities. The group, which is a listed entity, operates in distribution, supply chain and logistics management. Its operations are worldwide, spanning more than 200 countries. The group's strategy is to strengthen its market share and grow revenue in a sustainable manner by expansion into emerging markets. There are 50 subsidiaries in the group, many of which are international. There are 3 main business divisions: post and parcel delivery, commercial freight and supply chain management, each of which historically has provided approximately 1/3 of the group's revenue. A 4th business division which focuses purely on providing distribution channels for the oil and coal sector was established 2 years ago and in 2008 began to grow quite rapidly. It is forecast to provide 12% of the group's revenue this year, growing to 15% in 20x9. This division is performing particularly well in developing economies. In recent years, revenue has grown steadily, based mainly on growth in some locations where e-commerce is rapidly growing. This year, revenue is projected to decline slightly, which the group attributes to increased competition as a new distribution company has taken some of the group's market share in a number of countries. However, the group management team is confident that this is a short-term drop in revenue and forecast a return to growth in 20x9. Then what about innovation that they have said? The group has invested in automating its warehousing facilities, and while it still employs more than 250,000 staff, many manual warehouse jobs are now performed by robots. Approximately 5,000 staff were made redundant early in the financial year due to automation of their work. Redundant means removed. Other innovations include increased use of automated loading and unloading of vehicles and improvements in the technology used to monitor and manage inventory levels. Integrated reporting. The group is proud of this innovation and is keen to highlight these technological developments in its integrated report. The group finance director has been asked to lead a project task with producing the group's first integrated report. The finance director has sent the following request to the audit engagement partner. We would like your firm to assist us in developing our integrated report and to provide assurance on it, as we believe this will enhance the credibility of the information it contains. Specifically, we would like your input into the choice of key performance indicators, that is KPIs, which should be presented, how to present them, and how they should be reconciled where relevant to financial information from the audited financial statement. The publication of an integrated report is not a requirement in the jurisdiction in which the group is headquartered, but there is a growing pressure from stakeholders for an integrated report to be produced by listed reporting entities. If Bisson and Company accepts the engagement in relation to the group's integrated report, the work would be performed by a team separate from the audit team. So for now, we have to solve this part. Evaluate the audit risk to be considered in planning the group audit. You should use analytical procedures to assist in identifying audit risk. You are not required to consider audit risk relating to disclosures, as this will be planned for later in the audit. Okay, so we read the Exhibit 2 entirely. We got a background of the group. Then the third one is extract from consolidated financial statements. 4 is notes from the extract. And 5th is extract from audit strategy prepared by Vulture Associated in respect of audit of links. So we also have to read the audit strategy. The 2 points below are an extract from the audit strategy. Other sections of the audit strategy include the audit risk assessment, have been reviewed by the group audit team and are considered to be satisfactory. Lynn's company is projected to be loss-making this year, and this group audit team is confident that sufficient procedures on going concern have been planned for. Then what is the control effectiveness of the same? We will place reliance on internal controls, which will reduce the amount of substantive testing which needs to be performed. This is justified on the grounds that in previous year's audit, controls were tested and found to be highly effective. We do not plan to retest the controls, as according to the management, there have been no changes in systems or control environment during the year. And regarding internal audit, Link's company has offered the service of its internal audit team to help perform audit procedures. We are planning to use the internal auditors to complete the audit work in respect of trade receivables, as they have performed work on this area during the year. It will be efficient for them to perform and conclude on the relevant audit procedures, including the trade receivables circularization and evaluation of the allowance for trade receivables, which we will instruct them to carry out. Okay. So now let's answer the A part. You do not have to take any tension looking at the content. It's very easy, trust me. It's just like the section B that we solved. So you start your solution of first one, A part. Okay. Just read through the information. You have to find out the audit risks. Okay. And considering it to be a 24 marker question, it is going to be a big one. So that you have to prepare your mind to. Also read this part for audit risk, because audit risk can be from this also. Comparison of previous year with this year. So various ratios we will have to find. See. So let's do it. Just make a strategy in your mind. I'm giving you 5 minutes of how to start with it. Making that strategy is very important. So to start with, I have to start my answer in a format because the question has told me to do that. Evaluate the audit risk to be considered in planning the group audit. You should use analytical procedures. First of all, what are analytical procedures? Analytical procedures are analyzing information between the years to see if there is any growth or any downfall. So analyzing information between 2 years or comparing between two entities and looking for any fluctuations. Now, if they have asked you to use analytical procedures, you have to find out the ratios of last year and this year and see if there are any unusual trends in them. So we got the first idea of, okay, I want to find out ratios. Based on the ratios, I have to identify audit risk, because these ratios are going to help me to identify audit risk, and you're not required to consider audit risk relating to disclosure, as they will be planned later. So disclosure ke bare mein you don't have to say anything. Okay. So we got a first idea. Now this is an email which is sent by Maya Kag, and we have to reply to that email. So the pattern in which you write the answer is going to be in reply to the email, because if you read the question carefully, Maya Craig, our audit engagement partner, has asked you to do audit planning for Eagle, and now you have to reply to her that, okay, this is the planning that I have done, and in that reply all of this will come. So this is a part of the exhibit, that is an email. You also have to reply to that email. So your answer will start with you also will then write an email to Maya Kag, and you will write it as to Maya Craig, audit engagement partner, from audit manager. Then you will also write the subject like she has written in the question. Eagle Group audit planning. Okay, so this is how your answer will start, because they have also given you an email like this. So your answer will also be like that. And now you start from your. So say these briefing notes. One second. Are prepared to assist with the planning of the audit of the Eagle Group for the year ended 31 December 2008. You have to give an introduction in your email. So this is that introduction. So the notes contain an evaluation of the audit risks which should be considered in planning the group audit. The notes also recommend the principal audit procedures to be used in the audit of the goodwill which has arisen respect of a newly acquired subsidiary. then go on to evaluate and extract from the audit strategy which has been prepared by a component auditor. Now, first thing that they have asked you to do is the evaluation of audit risk using analytical procedures, and using analytical procedures in analyzing the information between the year to check for any deviations. For that, you have to find out the ratios. So the first one we have is evaluation of audit risk, and for that selected analytical procedures and associated audit risk evaluation. Okay, so we have to find it for 2 years. (20x8) and the previous year, which is 20x7. So the first one we have is operating margin ratio. So go here, operating expenses, and this is the operating profit. So operating profit ratio, that is operating margin ratio, is operating profit divided by sales into 100. So sales is the revenue. So 350 divided by 5770, 350 divided by 5770 into 100. So the first one here is operating margin, which is 350 divided by 0 into 100, and that is going to give you 6.1%. Similarly, for the last year, if you calculate, you will get 270 divided by 5990 into 100. So the second one, I am directly writing down the answer. It is 4.5%. And the next one we have ROCE, that is return on capital employed. So what is the return that you have got? 350, because that is an operating profit. So 350 divided by the capital that you have employed into the business. So what is the capital that you have employed in the business? Total equity plus non-current liabilities. So 350 divided by 2245 plus 650. So that will be, you write it down, 350 divided by 2245 plus 650. That is the total capital employed. So that is going to give you 12.1%, and similarly if you calculate for the previous year, it is going to give you 10%. Okay, then next if you see, we have to calculate the current ratio. Current ratio is what? Current assets upon current liabilities. So current ratio will be current assets 1450 divided by current liabilities 597. So it is 597. That is going to give you 2.4. And similarly for the last year, it is going to give you 2.6. 6. And next we have is debt upon equity. Debt upon equity or debt upon debt plus equity, anything is correct. So you go there. Then your debt is your on equity. So equity is 2245. This is the equity, your total equity, and the debt that you have is so here we have the total debt is 539. So that becomes 539 divided by the equity, which is the total equity. That is going to give you 24%. And then similarly for the previous year, it is going to give you total equity is again 2093, and your debt is going to be 500. So go there, it's going to be 500 divided by 2093, that will give you 23.9. So it's not changed much. Then next it's going to be interest cover, and the formula for interest cover is profit, that is operating profit, divided by interest cover. So what is the operating profit that we have? 350. So 350 divided by the interest, that is 28, and your 270 divided by 30. So interest cover is 350 divided by 28. That is going to give you 12.5, and this is 270 divided by 30, that is going to give you 9. Next we have is effective tax rate. Effective tax rate is going to be tax expense 64 divided by profit before tax. 64 divided by 322, that is going to give you 19.9%. And for the previous year similarly, it is going to give you 25%. So we got the ratios of last year and we got the ratios of this year. So now we can compare the ratios. So first let's pick the first one, which is remember in the first lecture I told you how to gain the professional marks with proper presentation. Now the group's operating margin has increased from 4.5 to 6.1. So right there, the group's operating margin has increased 4.5% to 6.1%. Despite a fall in revenue. If you see the question, the revenue is decreasing from 5990, it is becoming 5770. So despite a fall in revenue of, how much is the fall? 5990 minus 5770 is 220. 220 divided by 5990 into 100 will give you 3.67%. That is 3.7% is the fall in revenue. This is due to the reduction in operating expenses of, what is the reduction in operating expenses? Again, same formula, 5800 minus 5440 divided by 5800, so that is going to give you 4.5% and increase in operating income of, how much is your operating income increasing? Direct double it is becoming, right, of 50%. ROCE shows a similar positive trend despite the fall in revenue. So what is the audit risk in there? There is an audit risk that expenses are understated. With reduction in expenses being proportionately more than reduction in revenue. Okay, this is the first thing that you can say. But within operating expenses also, if you see, the trends are different in each category. So for example, within operating expenses, trends for each component are different. For example, cost of raw materials, consumables and supplies. You see from here, their trend is different. Their trend is different. Their trend is different. So every component of operating expenses which is clubbed together is this. Their trends are different in every component. So within operating expenses also, the trends for each component is different. So what happens in cost of raw materials, consumables and supplies? They are decreasing. They are decreasing by how much? 1780 minus 1725 divided by 1780 into 100, that is 3.9. So they are decreasing by that much percent. Sorry, 3.1, not 3.9. It's 3.08. So you do it as 3.1%, which appears reasonable given the decline in revenue, right? However, what can you say about the staff cost? The staff cost is increasing. So 3650 minus 3610. It is increasing by 1.1%. So whereas, however, the staff cost has increased slightly by 1.1%, which seems again inconsistent with the fall in revenue, with the revenue trend. And with the increased automation of operations, that is, now they have switched to robotics, right? Which has led to 5,000 staff being made redundant. Which presumably means less payroll cost this year. Expenses could be misclassified into staff cost in error. Next, if I want to see, I will talk about depreciation, amortization and impairment. It has also increased. How much is it increased? By 3.6%. How to calculate the increase? The difference between the two divided by 140. So again, if you talk about that, depreciation, amortization and impairment has increased by 3.6%, which is not a significant change, but will need to be considered, or rather will need to be investigated to consider how each element of the category has changed in the year. The most noticeable trend within operating expenses is that this is the most noticeable trend. Directly from 270, it is becoming to 20. So that is the most noticeable trend, is that of the other operating expenses category has reduced very significantly. it is reduced very significantly. Then next, about what I can talk. The operating income. How much is the change? %50 is the increase. So next heading I'll give is other operating income. And this information about other operating income is in note 6. So let's read the note 6. This is the note 6. So in that you have reversal of provisions, reversal of impairment losses on receivables and other assets, foreign currency gains, this and total. So this is about other operating income. So let's say about that. There is also an audit risk that other operating income is overstated. According to the information in, what is the note number? Note 6. During the year has been recognized as reversal of provisions. $60 million and last year it was how much? 40. So there's an increase of 50%. This is 50% greater than the amount recognized in the previous year. In addition, there's a reversal of impairment loss credit of 30. Credit of 30 million has been recognized for reversals of impairment losses there is a risk that these figures have been manipulated in order to boost profits as an earnings management technique. So it's like a earning technique wherein you are boosting the profits continuously in reaction to the fall in revenue. Then the risk of management bias is high given the listed status of the group. expectations from shareholders for a positive group trend. The profit recognized on asset disposal, that is 2, and the increase in foreign currency gains could also be an indication of attempts to boost operating profit this year. So basically, foreign currency gains and profit or loss on disposal. So whenever you have to remember that you have to answer it regarding analytical procedures, you always have to compare it, because you have to analyze the relationship between them and compare it and write it down. The next category we have is current ratio and gearing. Current assets divided by current liabilities is the current ratio and the gearing. So let's talk about that. About current ratio and gearing. Looking at other ratios, the current and gearing ratio do not indicate audit risk. However, more detail is needed to fully conclude on the liquidity and solvency position of the group. Then the interest cover, remember we calculated, so the interest cover has been increased from 9, it has become 12.5, has increased due to both an increase in operating profit and a reduction in finance charges. This seems contradictory to the increased borrowings. Okay. Then next, what can we write about? We can write about the effective tax rate. Last year it was 25, this year it is 19.9. The next one we can write about is effective tax rate. Has fallen from 25% last year to 19 point how much? 0.9%. And audit risk arises in that the tax expense and associated liability could be understated. This could indicate management bias. Then what is the next point we can write about? Goodwill or the intangible assets, equity, financial performance, operating expenses, termination of goodwill on acquisition, now if you see in the question, the group has operations worldwide, so it has many subsidiaries. So there can be an audit risk about the consolidation of foreign subsidiaries also. So consolidation of foreign subsidiaries. Given that the group has many foreign subsidiaries, including links company, audit risks relating to their consolidation are potentially significant. So it should be like consolidated properly, and you have to check the materiality of links, and if links is material, then you have to have that as a significant component of the group. And audit risks relevant to links company status as a foreign subsidiary also attach to the group's other foreign subsidiaries. Then this, at the year end, the subsidiaries balances needs to be retranslated using the closing rate. So that also needs to be done for foreign subsidiaries. So that is according to IS 21, that is effects of changes in foreign exchange rates, the assets and liabilities of links company and other foreign subsidiaries should be retranslated using the closing exchange rate, then its income and expenses should be again retranslated. At the exchange rates at the date of the transaction, the risk is that incorrect exchange rates are used for retranslation. Proper rates should be used for retranslation. In addition, Link's company was acquired on 1 March 20x8, and its income and expenses should have consolidated from that date onwards. There is a risk that full year's income and expenses have been consolidated. Okay, then what else? Measurement of exchange gains and losses. There's an exchange gain, right? See, foreign exchange gains. So the calculation of exchange gains and losses can be complex, and there is a risk that it is not calculated, because however, whatever the case is, we are identifying risk here, so it is not calculated correctly, or that some elements are omitted. For example, the exchange gains or loss on goodwill may be missed out of calculation. The relevant IS says that retranslation of subsidiary balances are recognized as other comprehensive income. There is a risk in incorrect classification. Okay. The next one we can say about is the goodwill, and then see the note number 1 for goodwill. Goodwill relates to the group's subsidiaries and is tested for impairment on an annual basis. Management will conduct the annual impairment review in December 2008, but it is anticipated that no impairment will need to be recognized this year due to anticipated growth in revenue, which is forecast for the next 2 years. Then, in March 2008, the group acquired an 80% of controlling shareholding of Link's company, a listed company located in foreign country, for consideration $351 million. Management's determination of goodwill arising on the acquisition is shown in Exhibit 4. So this is the goodwill calculation: cash consideration, contingent, total, fair value of NCI, less fair value of net identifiable assets, and the goodwill is 100. So regarding goodwill, what can you say? The total goodwill recognized in the group's statement of financial position is, for this year we just saw, 1,100 million, making it highly material. Okay. Goodwill has increased compared to last year. The goodwill relating to acquisition of Links is 100 million. According to management's calculations. Then according to IFRS 3 business combinations, goodwill should be subject to an impairment review on an annual basis. Management has asserted that while they will test goodwill for impairment, prior to the financial year end, they do not think that any impairment needs to be recognized. This view is based on optimistic assumptions. Then after that, what can you say? regarding the intangible assets. In that, capitalization is only appropriate when an asset has been created and specifically in relation to development cost, the criteria from IS 38 intangibles must be met. So this is one of the intangible asset criteria. Then one more, detection risk in relation to links company. It is the only subsidiary which is not audited by the same company. So this gives rise to risks audited. So a risk that the quality of audit might not be the same as Bison company. This results in increased deduction risk at the group level. The risk is increased by problems with the audit strategy prepared and will be discussed later in the briefing notes. Okay. So that's it about the first category. And then you can give a conclusion, and you can give a conclusion saying that the briefing notes indicate that there are large number of audit risks to be considered when you're planning the audit, and the management needs to supply you with audit team with a range of additional information for more thorough audit planning to be carried out. And the audit of goodwill in particular, that is the goodwill arising on acquisition of links company, is an area of significant audit risk because you are not doing the audit of that, and the notes recommend the principal audit procedures to be conducted. So you will end the answer with a conclusion saying what I just said just now. That is, there are large number of audit risks to be considered in planning the audit, and that the management may need to supply the audit team with a range of additional information that is required, and mostly the audit risk is going to be from the acquisition of links company because you are not auditing it, somebody else is auditing it. So finally, a firm needs to discuss the request to assist in preparing the group's integrated report. So that's it with the first question, that is this one, 24 marks. The second one we have is for 6 marks. Design the principal audit procedures to be used in the audit of goodwill arising on acquisition of Link's company. Management calculation of goodwill is shown in Exhibit 4. You do not need to consider the procedures relating to impairment testing or the foreign currency retranslation, as this will be planned later in the audit. So look at Exhibit 4. This is the goodwill calculation and this is the note on the goodwill calculation. So please go through it, then we're going to start. Till then I'll quickly check the comments. I'm quickly checking the comments on the live class. We can write the conclusion at the end after we finish everything also, because ultimately this is one answer which is an email that you're sending. So in between also, if you want, you can write the conclusion after the first one, or you can write it at the end also. Okay. So the next one we have is principal audit procedures. On the goodwill arising on the acquisition of Links company. So it is for how many marks? 6 marks. And for that you have to see the exhibit 4. The exhibit is this, and the note says the contingent consideration will be payable 4 years after the acquisition date and is calculated based on a payment of $525 million only payable if Links company reaches revenue and profit targets outlined in the purchase documentation. The amount included in the goodwill calculation has been discounted to present value using the discount factor based on an 18% interest rate. The non-controlling interest is measured at fair value, the amount being based on Links company's share price on 1 March 2008. The assets and liabilities acquired and the fair values were determined by an independent firm of chartered certified accountants, Sidewinder and Company, who was engaged by the group to perform due diligence on Links company prior to the acquisition taking place, and a fair value uplift of $12 million was made in relation to property, plant and equipment. So let's write down about that. The first thing that you will do for goodwill arising on the acquisition of Links company is that you will obtain the legal documentation pertaining to the acquisition and review to confirm that the figures included in the goodwill calculation relating to consideration paid and payable are accurate and complete. In particular, inform the targets to be used as the basis for payment of the contingent consideration in 4 years' time. Okay. The next one, also confirm from the purchase documentation that the group has obtained 80% shareholding and that this conveys control, because 80% is control, right? That is, the shares voting rights and there is no restriction on the group exercising their control over links company, because 80% is control. Then third one, agreed the 80 million cash paid to the bank statements and cash book of the acquiring company. Then what next can you write? Your favorite, review the board minutes for discussions relating to acquisition and for relevant minute of board approval. Then what else? For the contingent consideration obtain management's calculation of the present value and evaluate assumptions used in the calculation. Discuss with the management the reason you're using the 18% discounting factor. Reason for using 18% discount factor for calculation. Asking them to justify the use of this interest rate. What else can you say? Review the calculation of net assets acquired to confirm that the true accounting policies have been applied. Okay, so this is done, B part. Then C part, using the information provided in Exhibit 5, evaluate the extract of the audit strategy prepared by Vulture Associates in respect of the audit of Links Company and describe any implications for the group audit. So go to Exhibit 5. 3 Exhibit 4 Exhibit Yeah. So extract from the audit strategy prepared by Vulture Associates in respect of the audit of Links Company. 2 points below are an extract for the audit strategy. Other sections of the audit strategy, including the audit risk assessment, have been reviewed by the group audit team and are considered to be satisfactory. Links Company is projected to be a loss-making this year, and the group audit team is confident that sufficient procedures and going concern have been planned for control effectiveness. We will place reliance on internal controls, which will reduce the amount of substantive testing which needs to be performed. This is justified on the grounds that in the previous year's audit, controls were tested and found to be highly effective. We do not plan to retest the controls, as according to the management, there have been no changes in the systems or control environment during the year. So about control effectiveness, this is what they have said, and then about internal controls, what they're saying. Control effectiveness and internal controls. Links Company has offered the services of its internal audit team to help perform audit procedures. We are planning to use the internal controls to complete the audit work in respect of trade receivables. As they have performed work on this area during the year, it will be efficient for them to perform and conclude on relevant audit procedures, including the trade receivable circularization and evaluation of the allowance for trade receivables, which will instruct them to carry out. So what you have to do basically is you have to talk about control effectiveness. So this part is for 10 marks. So this was part B. This is part C that you have to do. So the extract from the audit strategy covers 2 areas. What are the 2 areas? Reliance on internal controls and reliance on internal controls, such as the control effectiveness and internal audit. Okay. So let's write about control effectiveness, clubbing both the points together. So what can be written about that? In relation to reliance on internal controls in relation to relying on work performed during previous audits on internal controls the relevant ISA, that is International Standards on Auditing, states that the auditor plans to use audit evidence from previous audit about the operating effectiveness of specific controls. The auditor shall establish the continuing relevance of that evidence by obtaining audit evidence about whether significant changes in those controls have occurred subsequent to the previous audit. The auditor shall obtain evidence by performing inquiry combined with observation or inspection to confirm understanding of specific controls. If there have been changes which affect the continuing relevance of the audit evidence, from previous audit, the auditor shall test the controls in the current audit. If there have not been such changes, then what? The auditor shall test controls at least once. Don't rely blindly, even if they are saying that their controls are proper, but at least once in every third audit. And shall test some controls each audit to avoid the possibility of testing all controls on which the auditor intends to rely on single audit period testing of controls and the subsequent 2 audit periods. What else can you say? Virtue Associates needs to do more than simply accept management's assertion that there have been no changes to control. There needs to be some observation or inspection of controls to confirm that there have been no changes and this work and an appropriate conclusion needs to be documented. In audit working papers. In addition, there should be testing of internal controls each year. So Vulture should plan and perform some test of controls each year. This is the explanation for control effectiveness. You can add one more point saying that the group audit team should discuss the issue with Vulture Associates to ensure that adequate control testing is performed. So that's with the C part. Then the D part says six mark after considering the request in Exhibit 2 from the Group Finance Director in respect of a firm providing advice on the group's integrated report, describe the ethical and professional implications of this request, recommending any further actions which should be taken. Exhibit 2. Integrated reporting. So what can be done for integrated report? So you can start the answer with this entirely is an email, by the way. And professional implications of the request to provide non-audit service of the group's integrated report. significant issue relates to auditor objectivity. The ethical standards for auditors provides requirements and guidance on situations where the auditor is asked by the client to provide non-assurance services, and the same company needs to evaluate the significance of the threat and consider whether any safeguards can reduce the threat to an acceptable level. While the integrated report is not a part of audited financial statements, the report will contain KPIs, and the group has asked for input specifically relating to reconciliations between these KPIs. And financial information contained in the FS. Okay. There is a potential self-review threat to objectivity in that the audit firm has been asked to provide these KPIs which are related to figures which have been subject to external audit by the firm. Then what else? It could also be perceived that the same company is taking on management responsibility by helping to determine content to be included in the integrated report, which is a threat to objectivity. The audit firm should not assume management responsibility to help determine content to be included in the integrated report, which is a threat to objectivity. Okay. And after that, you can write a final conclusion which says these briefing notes indicate that there are large number of audit risks to be considered in planning the audit, and the management needs to supply audit team with a range of additional information for more thorough audit planning to be carried out. So this is your entire email that you have written for 50 marks. Okay, obviously you can add the points. I've just given you, in some cases I've just given you the head points, that is the headlines, because the time will not permit us to do entirely. So that finishes question 1. Now we take a break of 5 minutes before we begin section B, question 2. So you read the requirement first. This is for 8 marks, and this requirement is split into 7, 5 and 5 marks. So 17 marks is requirement A and 8 marks is requirement B. So let's do requirement A. Recommend and explain the matters which should be discussed with management in relation to each of the proposed adjustments, including an assessment of their individual impact on the financial statements and on the auditor's opinion if management does not make the proposed adjustment. The first one, and that is regarding the lease of testing equipment. Let's read the question from the starting. You are an audit manager in Quorum and Company, a firm of chartered certified accountants. The audit of your client Clark Company for the year ended 31 May 2018 is nearly complete, and the auditor's report is due to be issued next week. Clark Company is an unlisted family-owned business which specializes in the services and repair of both commercial and privately owned motor vehicles. The company operates from 7 geographically distinct sites, each of which is considered a separate cash generating unit for impairment review purposes. The draft financial statements recognize profit before taxation for the year of $2.3 million and total assets of $22 million. The schedule of uncorrected misstatements included in Clark Company's audit working papers are prepared by the audit supervisor as shown below. You are due to attend a meeting with the finance director of Clark Company tomorrow, at which the uncorrected misstatements will be discussed. So this is the schedule of uncorrected misstatement, their effect on statement of P&L and statement of financial position. In the jurisdiction in which Clark Company operates, all motor vehicles over 3 years old are required to undergo an annual test of vehicle safety and roadworthiness. The annual test requires specialist testing equipment which is inspected by government officials on a regular basis. Following inspection visit in May 2018, the government inspection report required Clark Company to replace the testing equipment of 3 of its sites. In order to comply with this requirement, Clark Company agreed to lease new testing equipment from a leasing company on 6 months lease. Under the terms of the lease, the company has no option to purchase the equipment. The testing equipment was made available for use by Clark Company at each of the 3 sites on 31 May 2018. The client has capitalized leases with a total carrying amount of $625,000 at 2 of the sites, but has elected to take advantage of the IFRS 16 leases exemption not to capitalize short-term lease at the largest of the 3 sites. As a result, the present value of the lease payment of $475,000 relating to the site has not been recognized on the company's statement of financial position. This is the first lease of testing equipment that is there, and on this you have to recommend and explain the matter which will be discussed with the management in relation to the proposed adjustment, including an assessment of individual impact of that on the financial statements. So the first one is this question 2. So what can be done here in lease of testing equipment? Largest site is material. So find out the materiality of that. it is how much of assets, of total assets. Statement of financial position at 2.2%. The leases at the other two sides are also material, and find out the materiality of that also. And according to IFRS 16, leases and the lease liability at the commencement date of the lease at the present value of lease payments. The standard defines the commencement date as the date the asset is available for use by the lessee. Given that the commencement date May 20x8 it is appropriate on this basis to recognize the lease on the SOFP as at this date. Then it is significant, however, that IFRS 16 also contains an optional exemption for short-term leases of less than 12 months duration with no purchase option. If Clark Company elects to apply this exemption, it does not recognize the leased asset or lease liability statement of financial position, but rather it recognizes the lease payment associated with those leases as an expense in the statement of P&L for the year in a straight line basis over the lease term or systematic basis. However, IFRS 16 also requires that if this exemption is taken, it must be applied consistently by each class of underlying asset. Hence, in this case, the client must either capitalize the lease across all three of the sites or apply the exemption consistently and not capitalize the leases across any of the sites. If the client elects not to take the exemption, across three sites, assets and liabilities, will be materially understated. Hence, the audit supervisor's proposed adjustment is correct and the right of use is set and lease liability should be recognized in the statement of financial position. Alternatively, if the client does elect to take the exemption sides. Then assets and liabilities are materially overstated. And right of use asset and lease liability should be derecognized. On the statement of financial position. Then what will be the impact on audit opinion? If the client does not make adjustments to financial statements, the statement of financial position is materially misstated. On the basis of misapplication of an accounting standard, and the audit opinion to be qualified on the basis of except for appealing. Okay, so that is the first part. And the second one is regarding legal claim. So let's read it first. A customer of Clark Company successfully sued the company for negligence in April 2018. After suffering a personal injury at one of its sites, the court awarded the customer $1.2 million in damages, and this had not yet been paid as at 31 May 2018. The audit working papers include a copy of a verified letter dated 25 May 2018 for an insurance company confirming that the claim is fully covered under Clark Company's public limited insurance policy. On the basis that the company has no net liability as a result of the claim, the finance director has not recognized any amount in the financial statement and has not made any disclosures. Regarding this, what will you say? First, check the materiality. We answered a question like this yesterday. So, the legal claim is material to statement of financial position being 5.5% of total assets. Okay, that is the materiality. Now, following the requirements of IS 37, which is provisions, contingent liabilities and contingent assets, or provision should be recognized right? So a provision should be recognized when an entity has a present obligation be it legal or constructive as a result of a past event, and it is probable that the outflow of resources embodying economic benefits will be required to settle the obligation. And a reliable estimate can be made of the amount of obligation. In this case, the customer has already won the action against the company. The amount of the claim has been agreed by the courts and the settlement still outstanding. At the reporting date. Hence, a provision should be recognized in the IS 37, that is provision contingent liabilities and contingent assets, also states that contingent assets are not recognized in FS since this may result in recognition of income which may never be realized. However, the standard continues by stating that when the realization of income is virtually certain, then the related asset is not a contingent asset and its recognition is appropriate. The audit supervisor proposed adjustment is correct, and the finance director should therefore be requested to adjust is the financial statements include the separate obligation to include the separate recognition of assets and the provision. So what else can you say about the legal claim? What will be the impact? Audit opinion. The client does not make any adjustments to FS. The statement of financial position is materially misstated and the audit opinion should be qualified on the basis with an except for opinion. Okay, so this is what you will say about legal claim. And the third one we have is asset impairment. So what will you say about asset impairment? You have to read it first. And this is for 5 marks. During the year, a significant new competitor entered the market at one of the Clark Company's 7 sites. As a result, the site has experienced a decline in market share and revenue. The company has therefore conducted an impairment test on the site's asset. The company's working papers for the impairment test have audited the following figures. Please go through it. You should use IS 36 impairment of assets for that. So let's write down. As I told you, you have to use IAS 36 impairments. According to IAS 36, impairment of assets, an entity should assess at the end of each reporting period whether there is an indication that the asset or a cash generating unit may be impaired. If such an indication exists, the entity shall estimate the recoverable amount of the asset. The standard states that potential impairment indicators include external sources of information, such as significant changes in the market in which the entity operates. As each of Clark sites is considered as a cash generating unit for impairment review purposes, it seems appropriate therefore for the company to have conducted an impairment review at this site. IAS 36 says that an asset or cash generating unit is impaired when the carrying amount exceeds the recoverable amount, and it defines as the higher fair value less cost to sell and value in use. The audit supervisor proposed adjustment is therefore correct, and the finance director Here in between I have left a space, you have to do the calculations, okay? Of fair value less cost to sell, value in use, that's the recoverable amount and all of that. The audit supervisor's proposed adjustments is therefore correct and the finance director should be advised of this error at tomorrow's meeting, even though the amount is immaterial to both this statement of financial position and statement of P&L for the year. Even though it is immaterial, you have to do that. It is appropriate to request that the adjustment is made to financial statements. And last and the most important point, impact on audit opinion. Given that assets are both immaterially overstated, if no adjustment is made to the financial statements, it follows that there will be no impact on the audit opinion in relation to this matter in isolation. Okay, so that is regarding the first part, which is done. Now the second part that you have is for 8 marks. Comment on the ethical and professional issues raised in respect of audit of Turner Company and recommend any actions to be taken by the auditor. So I want you to really think on this and give me an answer. We shall read it. Your client portfolio as an audit manager at Quorum and Company also includes Turner Company, which is a listed financial institution offering loans and credit facilities to both commercial and retail customers. You have received an email from the audit supervisor who is currently supervising interim testing on systems and controls in relation to the audit for the year ending 31 October 2018. The email gives the following details for your consideration. One of the audit team members, Janet Stott, has provisionally agreed to take out a loan with Turner Company to finance the purchase of a domestic residence. The loan will be secured on the property, and the client's business manager has promised Janet that he will ensure that she gets the best deal which the bank can offer. The payroll manager at Turner Company has asked the audit supervisor if it would be possible for Quorum and Company to provide a member of staff on secondment to work in the payroll department. The payroll manager has struggled to recruit a new supervisor for the organization's main payroll system and wants to assign a qualified member of the audit firm staff to join for the initial period of 6 months. So What are the ethical and professional issues and actions to be taken by the audit firm? Loan to a member of the audit team creates a threat to the auditor's independence, right? Because the loan is not made in normal lending procedures and the terms and conditions are not normal. So a self-interest threat would be carried and would be created as a result. The self-interest threat arises because there's a potential benefit. You have an interest in the company because they have given you a loan. Okay. And the threat arises because of the fear that the audit client may, for example, change the terms of the loan, may recall the loan that if you do this, give me my money back, or if you do this, I will charge that much interest. So that is why there's a self-interest threat, and this loan is not made under normal lending conditions because the two parties are related parties. Then there are threats to objectivity, and they are normally considered to be so significant that no safeguard could cancel out the threat or reduce it to an acceptable level. It follows, therefore, in most cases that audit members should not accept such a loan or guarantee in any situation whatsoever. So you can write the answer based on that points. The ethical standard also says that a loan from an audit client, which is a bank or a similar institution, if it is made under normal business conditions, then the loan is acceptable. But if it is not under normal lending procedures, or if it is not under normal business conditions, then it should not be selected. Normal business conditions are what? Home mortgages, car loans, credit card balances, etc. Then it is possible that the secured loan may be ethically acceptable, and the key issues is where the very best terms which the bank can offer fall with Turner PLC's normal business terms and conditions. It might be possible that it is in the normal business conditions, and you have to explain the rationale. You have to decide if it's in the normal business conditions or no. Then you have to decide the outcome of that matter. So that is the first part of the loan that is given, and the second we have is the temporary staff arrangement. There's a temporary staff assignment that has happened. So I'm only doing the work and I'm only checking my work. Lending to staff to an audit client. I'm giving staff to my client. So it is a self-review thread. They are only doing the work and we are only reviewing the work. So we are reviewing the work of our own team members. So again, this is a self-review thread. Again, I have to see the safeguards for this thread, if the thread can be reduced to an acceptable level. Also, the nature of the work that my members are doing with the client should be considered. If it is very important to give the assistance, then the assistance should be given for a short period of time, and the staff should not assume management responsibility there. The client has requested the staff for 6 months, which may be considered a long period. If for 15-20 days it is there, then it's okay, but for 6 months is a considerable period. The nature of the work performed by the loan staff is also an important consideration. Therefore, it's better you decline such offers. So the audit manager should decline the proposed staff arrangement in relation to the payroll service, because 6 months is a very long time. If they would have asked it for 1 month or 15 days, it would have been good, but it will create a serious self-review threat, because my team members are going there and working and my team is only going to review their work. So it is a very important and very crucial self-review threat, and there can be no safeguards that can reduce the threat to an acceptable level. So this should be rejected. Okay, so that's it with this question. In tomorrow's class, we will do the question 3, and that will complete our entire mock of AAA. Thank you so much for attending the lecture. I hope this lecture was useful to you guys. Please attend tomorrow to see the last question, and then from the next mock paper, we're going to pick bits and pieces of the question. A few we are going to discuss orally, a few we are going to write and discuss. Okay, thank you so much. Happy studying.